Hey everybody, it's Brian. Thank you so much for being here. We're about to get into our next lesson, which is on money management. This is one of the pillars that support your trading business. So I've committed to keeping these lessons fairly short, about 15 minutes or so. So I want to honor that and kind of forego a lot of the formalities, although I do need to put up a couple of disclaimers to let you know, or remind you rather, that I am not an investment advisor. I'm not a licensed investment advisor, and I don't pretend to be one. I'm just showing you the information, the tools, the techniques that I've learned through the years that have helped me be successful. And I know if you apply these tools and techniques, you can be successful too. Second thing is trading involves risk. There's a huge upside to trading, but there's also the other side of that, which is a huge downside to trading. So it's very important that you're actually trading with risk capital, not money that you need to pay your rent, pay your mortgage, put food in your belly, put gas in your car. All right? I'm not going to go into a whole lot of detail on that. Suffice it to say, risk capital, very important when it comes to trading. So let's talk about money management. I feel like this is one of the keys to success in being in the business for the long term. Trading is a very emotional game. It really is. And we need to have some processes in place that help us, I don't want to say control, but help us work around and have things that allow us to keep emotion out of the picture. And if we're doing things in a very consistent manner, meaning we've got a good process and plan for looking at the market, looking at the news, looking at the various triggers that we're going to have to enter a trade, and then have a good process for how we manage that trade, how much risk we take, and how we actually manage that trade. That helps us keep emotion out of the market, and by doing that, it helps us be consistent with our execution day in and day out. Right? So money management is a very key part of that. Money management also comes into play when we're talking about win ratios. As you guys start doing more with trading, you might start looking at different trading systems, trading methods, trading mentors that are out there. A lot of these things that are going to come up in your news feed on Facebook, through emails that come to your inbox, they're probably going to talk about, I've got this great system and it produces 85% win rate. Okay, well that's awesome. That is great. The thing is, it doesn't matter if you don't have a good money management process behind it. Win rates are meaningless without money management. Now, why do you say that? Well, I mean, you could win 90% of the time. The challenge is if you're over leveraging yourself, if you're, basically betting 100% of your account on every trade, as soon as you have a losing trade, you're wiped out. Doesn't matter. It doesn't matter how great that system is. Also, a lot of times folks misunderstand win rate with expectancy, and we're going to talk about that as we get later in. A few days from now, we're going to talk about a little more about mindset. We're going to talk about odds and probabilities, and as we get into that, I think it'll help shed some light on the reason that win rates don't matter if you don't have money management behind it. But we'll get to that later on. I'm going to try to keep this on task and on target. But suffice it to say, we've got to have a good plan around how we manage our money so that as we hit periods of drawdown, and notice I said when, not if, as we hit these periods, when we hit these periods of drawdown, that we don't blow our account out. Having the right level of risk is very important. Now, what level of risk should we use? Well, I would typically say to a new trader, keep it as low as possible. 1 or 2% risk is probably the max, 2%, probably the max that any brand new trader should utilize as you're coming into this. Now, why is that? Well, there's a couple of reasons. One, lower risk, it takes some emotion out. We're already trading with risk capital, so we should be prepared at a larger level that money could go away. And if that happens, fine, so be it. We're not going to decrease our quality of life because that money went away. So automatically, by using risk capital, we should be less attached to it. Not to say that you're not attached to it. It sucks to lose money. Secondly, by keeping our risk low per trade, when we have losses, it's not a huge amount of money. So at that point, or it's not a huge percentage of our account. So at that point, again, we can live with it. It's easier for our subconscious to accept. So keep it down. Keep it about 2% at the very maximum. I feel like probably 1% is a great place to start, but keep it at 2% max. You can always change that later on. Now, I'm sure you're going, well, Brian, how do I determine what's 2%? How do I know what amount I'm risking on any account? Well, we can get to that, and we're going to get into that as we start talking about the different types of markets that we can trade, because it varies from market to market. In Forex, we talk in pips. In futures market, we talk in ticks and points. Now, I know you don't know what those things mean yet. That's okay. We're going to get to those. We're going to talk about those definitions down the road. But basically, you're simply going to look at where you're entering the market and where your stop point would be. So if a trade moves against you, we need to have a predetermined location of where we would want to exit that trade to ensure that we don't just keep digging a deeper and deeper hole with our losses as the trade moves against us, right? So we need to have a predetermined point of where we leave that trade. So what we're going to do to determine our risk level is we're going to look at our entry point to our exit point. How many pips or points is that, or pips, ticks, or points is that, right? Once we understand how many that is, and we know what the value per point or per tick or per pip is, then we can say, okay, from my entry point to my exit point is X number of dollars, and then based on that, we can determine how many lots we would want to trade. Now, again, I've used some terminology that you may not be familiar with, and that's okay. We're going to get to that. We're going to define what those things are as we get to each of those markets and what they mean and how they're calculated. But for right now, just suffice it to say, entry to exit is your risk. We don't want that dollar value to be any greater than 2% of your trade. And again, you can change that down the road. Once you've got some good data behind you, once you've got a large volume of trades behind you, you can start looking and say, okay, well, I can see that my maximum series of losses over the last 300 trades has been X. So I know that based on that, my maximum drawdown has been Y. And then you can back into saying, okay, I'm comfortable based on this with ratcheting my level of risk up to be a little bit higher. That's totally up to you. I'm not telling you what to do with your money. I'm just simply suggesting that maybe 2% isn't any more than you probably should go, especially as a brand new trader. It helps keep emotion out of it. Now, emotion does happen, and it's important to have kind of a plan in place to say, when should I stop for the day? It's going to happen when we have a day where we've got back-to-back losses. We might have a loss and a win, and then another couple of losses. At any rate, in order to keep emotion out of the game, or keep emotion from overcoming the game, I feel like a good rule of thumb would be if you're down more than 5%, if you're down 5% or greater in a day, it's a good time to just stop and walk away. Now, why is that? Well, again, as I've said over and over, emotion, mindset comes into play. Very often what happens, and I've seen this time and time again, I've even experienced it personally, is when we start to reach a certain level of drawdown, we start getting into this mindset where we want to, quote, get it back. And when we start feeling like we need to take another trade to get it back, we're doing ourselves more harm than good. We're becoming gamblers instead of traders. We're looking at the charts. We're looking at what's happening in the news. We're looking at what's coming up, and we're trying to find something to justify taking another trade so that we can get it back. And we often end up digging the hole deeper. You've heard the saying that if you go looking for trouble, you're going to find it. The same thing happens in trading. If we go looking for a trade, we're going to find it. We're going to somehow justify why we should be in a trade and why that next trade is going to be the one that, quote, gets it all back for us. Trading is really interesting. We've got to be able to step out, kind of outside of our bodies, and recognize when we're becoming emotional. If you keep yourself to this rule and say, if I'm down 5% or maybe a little bit more than 5%, I'm going to stop for the day, it helps you avoid getting into that emotional trap. Right? Now, it does happen where sometimes we do get emotional. Let's say you've broken rule 1 and you're risking more than 1 or 2% per trade. And then you broke rule 2 and you're down more than 5% for the day. Don't let it keep going. You got to know when to just stop and cut your losses. So if you can't let go of a trade, you've gotten tied to it, you didn't set your stop loss, or maybe you forgot to set your stop loss and the trade just suddenly ran away against you, close it down. Especially if you're approaching that 20% mark where you're drawing down or in a loss of around 20%. Now, why do I say that? Well, the little chart on the right-hand side of the screen talks about what it takes to get back to break even if you've experienced a loss. So if you're down 5%, you need about 5.5% to get back to break even. Not a big deal. You're down 10%, you need 11 to get back. You're down 20, you need 25. It's still manageable. But you start getting beyond that. You're down 30%, 40%, 50%. Look at where you have to be to get back to break even. This is why there's kind of this parabolic move in traders as emotion starts to come in. Once traders start experiencing drawdowns of 20%, 30%, 40% and greater, there's an accelerated decrease in their account size. And that's because emotions comes into play and they start ratcheting up their risk trying to, quote, get it back, because you need so much more with each trade in order to get back to break even. Don't break that rule, man. If you're down 20%, stop, right? So you've got 3 rules there. Rule 1, control your risk going into the trade. Rule 2, if you're down more than 5% for the day, stop. Don't keep trading. Rule 3, the one that you just don't want to break. If you're down 20%, let's close all the positions and regroup totally. Go back, look at your notes. How well are you following your process? How well are you executing the plan? Have you let emotion come into play? What's the cause? What's behind this? And it could be that you're doing everything right and you've just hit a stretch in the marketplace where you've had a series of losses where the plan just simply isn't working as it planned. And in the larger scheme of things, it probably will come back around. But we need to make sure that we're actually executing our plan correctly. So get out, stay out until you do that research and go back over your notes. All right? So to quickly summarize, control your risk. Use predetermined stop levels. Understand where your entry is, the distance from your entry to your stop, and what that means in a dollar figure, and then be sure that you're not putting on a higher number of lots or contracts than can be utilized by your account to have more than a 1 or 2% risk, right? If you're a new trader, definitely don't risk more than 2%. That's my suggestion there. Stop for the day if you're down 5 or more, and then close everything and just regroup if you're down 20. Go back and do some really good research. Step outside, look at it from kind of a third-party view, and see what you've been doing that's gotten you to that point where you're down 20%. All right? So that's it for now. We're going to keep building on this. Risk is going to come up in other exercises as we get into talking about the different markets tomorrow. We're going to talk about the different markets, the types of brokers that are out there, the requirements for trading the different markets, kind of the minimum requirements, if you will. We'll talk about that tomorrow. That'll help us understand more about risk. As we get into the trading types, as we get into developing the system a couple of days from now, where we're looking at trends, looking at support and resistance, looking at some of the basics around the market, again, that's going to help us understand more about the risk that we can take and how we can calculate that. So we're going to keep building on this. And then a few days from now, probably towards the end of next week, we're going to get back into mindset. As we develop our trading plan and put it all together, we're going to talk about how mindset comes together with odds and probabilities and how that will play into our calculation of risk. So risk is a pillar. It's one of those foundation pieces that we have to understand in order to have that longevity in the marketplace, and we'll keep revisiting this. All right, so that's it for me for now. I will see you tomorrow when we start talking about the different markets. Have a great day. Thanks for being here. We'll talk to you soon. Don't forget to share this video if you like what you've seen, you like what you're learning, you want your other friends and family to participate in this with you. It's a really good idea to have a support group as you're learning this that you can bounce ideas off of and talk about, especially as we get into the plan creation and the practice. It's really good to have a good support network there. So share this video, share the page, share the site with your friends and family. Thanks for your time. Have a great day. Bye.